Thank you everyone for coming today. We absolutely appreciate the time you're going to spend with us. I want to change the story slightly going forward and follow the quote of this gentleman, Seth Klarman, who's one of the greatest investors of our time, who said that the story of the stock market is a story of cycles and human behavior effectively overshooting on the up and on the downside. What I'm going to focus on is the human behavior side, since Johnny and David has focused a lot on the market so far. Behavior is driven by what we see and feel, all right? So this is a view of what your clients have experienced over the last couple of years. None of this should be a surprise for you. Up until 2014, the South African equity market delivered fantastic returns, even though there was a severe blip in the middle in 2008, great financial crisis, effectively a 16% return per annum. Any fund with some equity exposure would have done fairly well. Every single asset manager presentation that I attended during that point in time, the asset manager was warning, saying this line cannot continue like this. We're borrowing returns from the future. Some form of a low return world is coming. Lo and behold, none of us believed them, but they were roughly true. Since mid-2014, we've effectively had a flat equity market. And that now translates when you sit in front of your client, you do a client review, you typically look at fund fact sheets and the client's performance. How did the client do over the last 1 year, last 3 years, last 5 years? If you look at the 5-year numbers to the left, you'll effectively see your equity funds at the top, multi-asset, high equity, your typical balanced fund, typical conservative balanced fund, income and inflation. That is the normal picture you would expect, i.e. clients take more risk at the top and get rewarded with higher returns over the longer term, outperforming cash and income. However, if you pull it across that flat period we've just seen, today you're doing a client review and looking at that last 1 year return, effectively equity and balance funds are flat, cash funds, income funds have delivered you 7.5%. Your client is sitting in front of you and saying, Mr. Advisor, why should I actually sit in these funds? I take a lot of risk, volatility, and I don't even outperform cash. What the hell are we doing? So why invest in equities after all? Why should we? This is a 40-year picture of real returns after inflation. Effectively, over a 40-year period, equities have outperformed cash and bonds 7-fold. So if you think 40 years are too long, if you start working at 25, retire at 65, that's 40 years. Live another 20, 30 years, that's 70 years. I should have used the 70-year graph. There wasn't space on the graph for that picture. So I'm not advocating you should be 100% in equity. What I am saying is, for clients who invest over a very long period of time, they are more likely to get the inflation-beating growth they need out of equities. At least they have some exposure to equities. In cash, if you invest for 1 or 2 years, fantastic. If you invest for 40 years, you're going to save yourself bankrupt, which is not the idea when you save. So I try to make sense of this whole thing in my mind and say, so how does this investment game work? And I found this quote, which first took me by surprise, because sometimes I think investments are very simple and sometimes I think it's very complex. Warren Buffett had this quote which says, investing is simple but not easy. Now for someone who was brought up in Afrikaans using English only in self-defense, I had to consult my friend Google on this, who told me the following. Simple means you can understand it fairly quickly, right? Understanding. Easy means you can achieve it without great effort. So the one is to understand, the other one is to actually do it. Right, so let's go a bit further into this. On the understanding part, investing is fairly simple. If an asset has an intrinsic value, and that is a subjective thing, it's a fuzzy line. We all know if you take an equity, the actual price of the asset will fluctuate above and below the actual value. So the concept of investing, let's assume here the asset is cheap, here the asset is expensive. So understanding investments is simple. What you do is you buy the asset below the intrinsic value, you keep the asset for, let's say, 3 to 5 years, till it's at or above its fair value, and you sell it. Quite simple to understand. So why don't we all do it? At this point in time, it's a fairly painful point in time. David showed you on his graph Nenegate when bond yields spike. Bond yields were cheap at this point in time. How many asset managers and how many clients wanted to buy SA bonds at that point in time? We lost many clients saying we're absolutely crazy holding on to SA bonds. South Africa is going to go. We all read in the papers, and obviously what you read in the paper is true because it's printed. South Africa is going to go to the dumps. It also happened in 2008. Whatever, pick a share. Johnny mentioned Anglos, Old Mutual was trading at R4.50. So either it's going to go bust or not. Who of us bought the shares at that point in time? So assets go through these cycles. If it wasn't painful to buy assets here, every one of us would have bought the asset, the price would have corrected immediately. So it's painful to buy those assets. Yeah, it's obviously jollification, it's very good news. Let's pile in some more because everyone can look at the historical returns. The easy to do part, this is what clients experience, and I've particularly most of the time we put things on a log scale here. I've not done this in this instance because I want to show you the client experience. This is the SA equity market. Market does 164%, PE 10 odd, then it falls again. The PE falls, then the market goes up again. So clearly, what do we do as clients and investors? We look backwards. What is the historical performance has been? What does guys like Johnny and David do when they invest assets? They look at what is the value of the asset going forward. That's why I've put the price earnings ratio or the forward PE in for you as well. So when the market falls, we look at minus 13%. They look at the asset has just become cheaper. Maybe it's a good time to buy. And this period obviously plays out over and over again. Just as we get the gist of an up and down market, the market gives us a roughly flat market. And what do we do this time around? So it's not so easy to do, although the theory is fairly simple. I've given you a picture here of the SA equity market. Now, I'll just pause on equities for a while, then we'll go into other assets. But if you look at SA equities only, this is the last 37 calendar years of the SA equity market. Every dot on the graph represents, in every calendar year, the biggest fall from peak to trough in that calendar year. The average of those dots are minus 16.3%. So in framing the expectation, Mr. Client, I need to invest you in equities or in some equities, understand that the average experience you're going to get, the average, not the extreme, the average, every year a minus 16% fall. That's average. So when that happens, don't phone me, it's average. These are the calendar year performance of the market over the same time. 30 out of the 37 years I've actually delivered positive performance. By the way, I looked at the graphs again this morning. If we're talking about this massively volatile world, we're playing in the 20s and 30s here. Look at the 80s, have been 40s and 50s. So it pays to keep that asset. So even if you take an extreme year at some point your client phoned you and my equity portfolio has dropped 33%. If you just kept it for that year, you ended on -5. Not that -5 is fantastic, but I think it's a hell of a lot better than -33. Right? And you can take a number of examples. So you need to understand, in order to get that 7 times multiple in real terms over the long term, it doesn't come for free. You need to get on a bit of a roller coaster, and importantly, not get off at the wrong time. So we all of us don't only invest in equities. I'll go a bit more to balanced type of funds to give you the experience. This is the interest rate cycle of South Africa over the last 50 years. What I've then done is to say, during this time, how does equities perform relative to cash? And I've taken rolling 12 months period, equities less cash. And I get the following picture. Red is when equities outperform cash, gold is when equities underperform cash. And I had to ask my guys who did this for me a couple of times, is this scale correct? It looks too big. It is correct. So clearly, through interest rate cycles, our clients experience extreme volatility. Now let me dive a bit into the most recent portion of this graph for you and try and see what clients experience. So as we go up in the interest rate cycle, just over the peak, cash outperform equities. And we all know clients don't only invest in cash and equities. So I've put a number of funds here. Money market funds, multi-asset, low equity didn't exist at the time. Your conservative balance fund, that's your typical balance fund, that's your typical equity fund. So if you sat in front of your client at this point in time, 12-month return to that point, minus returns out of equity and balance funds, cash did 15%. So what does your client tell you? Mr. Advisor, no way I'm going to sit in these things. I'm taking all the volatility. I could have been in cash, not getting any volatility and get 15% more. So what do? You switch from here to cash at that point in time. So let's roll it forward 12 months. As you come down in the interest rate cycle, cash rates come down, declining interest rate cycle, fantastic for risk assets. Equities and balance funds rebound, outperform cash, but now your client moved there. Take another period, you go through the interest rate cycle, you just get to after the top, again, cash outperform your risky funds. Client says, let's switch out of the risky funds to the cash. Safe haven of cash, no volatility, and I do better than equity and bonds, equity and balance funds. Roll it forward another 3 years, another 12 months, and the picture goes the other way around. Clearly, downward interest rate cycle, better for riskier assets. These things outperform cash, but now your client sits in cash. And you can roll this picture forward a number of times. It repeats itself. Today, we sit at this point in time. David has mentioned his conversation with the Reserve Bank. They think we're at the peak of the interest rate cycle. Clearly, the cycle is not as pronounced as it has been before. You sit in front of your client. His equity or balance fund did 1 or 2%. Cash did 8%. Your client needs to draw 7% income. It puts pressure on you. I'm paying you a lot of money. Let's move. Let's move to cash. Is this the right time to do this? So we see the cycle repeat itself over and over. So let's look at a couple of funds where I think your clients would be in. So the gold line is a money market line, the red line is a balance fund. So at some point in time, you sit in front of your client, you do a review. We've now learned we don't look at 1-year investment returns. Clearly, over the last 1 year, cash significantly outperformed the balance fund. Let's look at 3 years. Investment's a long-term game. Look at 3 years. Cash still outperforms balance funds. What do we do? So what are the options to your client at this point in time? So your client now sits in this balance fund over here. You can switch out to cash, and going forward, you get a cash return. Nice steady line, that's where you end up 3 years later. Or you can go to a conservative balance fund, take some risk off the table, and you actually outperform the cash line at least nicely. That's where you end up. Or you can do nothing and remain in your balance fund. I think the important thing to take from this slide is, instead of moving between fund categories, at this point in time, you can sit with your client, assess what's in front of you, and make an active decision to do nothing. That's an active decision. Your client says, Mr. Advisor, I'm paying you a lot of money. We need to do something. You can say, yes, we are doing something. We are doing nothing. The interesting thing, if you look at the theory of behavioral investing, we all suffer from various biases in our heads. It's just how our brains are wired. We suffer from one thing called a recency bias. At that point in time, we look at what happened over the recent past, and then we extrapolate that forward, and then we try to protect ourselves. So we extrapolate that line downwards, this one upwards, and we make the switch. What the scientists have also found, after a period of poor performance, the human desire to do something increases significantly. It's like a rugby team coach who lost 3 or 5 games in a row. What's he going to do? He's going to change half the team. Because lo and behold, you can't play another game and lose again and you haven't done anything, right? Let's even look at funds within a category. I've taken the conservative balanced fund, the Prudential low equity category. So our inflation plus fund would play in this category. Asset managers also goes through cycles. Now, these are stable-ish funds, right? They're not as pronounced as equity. But at some point in time, you sit and look at the performance of the two funds. The red fund -6, this fund 8. Over 1 year, let's look at over 3 years. Clearly, the red asset manager has lost it here. They've gone bad. They don't know how to manage assets anymore. The client put pressure on you. We need to change something. So if we now in this red fund and we change to the gold fund, going forward, get a decent return. However, if you just stayed in the fund, as asset managers also go through cycles and they don't become bad all of a sudden. If you stayed in either of these funds, you would have had a much better outcome than you switch at the extreme point. By the way, these are two of the top managers and in the category, two of the top performing and therefore biggest funds in the category. Both are good management houses, good funds, nothing wrong with them. But they go through cycles. Be very careful of doing something at the wrong point in time, purely because of a client pressure or of whatever the case may be. The interesting thing is, after I seen Johnny's presentation, I thought, does this client behavior only impact active funds? So I looked at passive research I could find. These are 3 of the biggest ETFs in the world. They track the S&P 500. That one, they call it the Spider 500. It's the biggest ETF in the world. It's more than $200 billion US. These are the 10-year returns of them, and they've delivered what the index have delivered you. If we calculate the average client's return, so we take the net flows into and out of those funds, so that's what the funds deliver. The aggregate client, if there's such a thing, this is what they got in each of them. That's a 3.5% per annum difference over 10 years. By the way, 3.5% difference over 20 years is double your money. Who of your clients would like double their money when they retire? I guess every single one of them. So even the passive products who offer you the market return, the clients who are investing in them are making the same behavioral mistakes. And I guess that makes sense. We remain clients whether we invest in active or passive. I had a look at another fund again. Fantastic fund. It's not a Prudential fund in the conservative balance category. What I did is I looked at the rolling 12-month performance of this fund. And the red line is the percentile ranking of this fund in its peer group relative to all the other funds in that category. So the top block is first quartile. This fund is in the top 25% of the funds in the category. And the bottom layer is the bottom quartile. It's in the bottom 25%, comparatively speaking. What we then did is all these vertical blocks represent quarters. We tracked the quarterly net flows into this fund. All understand what I'm trying to do here. So clearly, after a couple of quarters, the fund rolling 1-year performance look good. We see positive flows into the fund. Then all of a sudden, the manager becomes very bad, drops to fourth quartile. What happens? What does the clients do? Look at past returns, take out money. Then all of a sudden, the rolling 12-month performance goes to first quartile again. Guess what the clients do? All of a sudden, we follow a good manager again. But lo and behold, the manager falls to fourth quartile again. Over rolling 1 year, I bet you can't guess what the clients do this time. And the story continues. If I were to draw a rolling 5-year graph, comparative, it would have been roughly here. Fantastic fund, fantastic asset manager. Clients, the flows go in and out. Look at the scale of the flows, R1 billion a quarter. This is not just simple client clicking his R500 investment and switching. This is big chunks of money. You can think what types of clients are moving here. What is the impact of that? So I did the same calcs again. Over the history of that entire fund, that's what the fund delivered. This is what the aggregate client in that fund got since inception. 2.5% per annum different. So in other words, the fund delivered 50% more return than what clients ended up on. 50% more return. And again, that was a rolling 12-month performance. What do you think that asset managers say on the fund fact sheet? Is he targeting a rolling 12-month performance? Absolutely not. 3 to 5 years at least. That's his investment horizon. So there's a disconnect between what clients are doing and what the fund manager is doing. So just to put it into perspective, if you invested money in the fund and after the 16 odd years, the fund would have ended with R1 million, the aggregate client ended on 650,000 rand. If you translate that into a 5% per annum income, it's the fund offer 53% more income than what the average client got. And if you think I'm picking only one fund here, we did the same work on a number of balanced and conservative balance funds. Those are 10 funds that represent more than 400 billion rands of assets. I'm very sure these are the funds that you and your clients are most likely using. So it's a quarter of the entire unit trust industry. Since each fund's inception, the red bar is what the fund delivered, the yellow bar is what the aggregate client got. There's a 3.5% difference over that 16 odd years. The funds delivered 68% more than what the clients got. Purely because of behavior. It's all after fees. It's just a behavioral thing. We buy high and sell low. So what's the conclusion I'm taking out of here? Effectively, if you go and track all the best investors in the world, the George Soroses, the Warren Buffetts, the Seth Klarmans, each and every one of them have worked out a robust investment process that works for them. It's different for all of them, but they've got their own investment process. Effectively, what the investment process does is it helps them overcome their own human biases because they also make human mistakes. What my suggestion is, each one of you should have an investment process that you follow with your clients. Please make sure you align your process's investment horizon with that of the funds you're picking. Otherwise, there will be a disconnect and the marriage is not going to end happily. Also, do your homework up front. Is this a good manager or not? Is the fund doing the right thing that my client wants? And then pick the fund. But once you've picked that fund, stay there. Whether it's a Prudential fund or a comparative fund, I don't particularly care. Please stay there. Because that's how your client will get the actual benefit. At Prudential, clearly we would like you to invest with us. We have also got a process that we've worked out. It works for us and it works for our clients. Over a long period, both of our funds, probably our most popular funds that you guys will probably use, our Balance and our Inflation Plus fund, both since inception, they have handsomely outperformed the average fund in the category and their benchmarks. If you select these funds, we would be delighted to look after your money. Please stay invested then. Don't chop and change. Clearly, the rankings of the funds are more volatile in the shorter term. Over the long term, you can clearly see our investment process has delivered to our clients, and we would be delighted to look after you, some of your clients' money as well. Thank you very much for your time.